Manufacturing facility loans, SBA, USDA, and bank options. In financing a manufacturing facility is rarely as simple as finding the lender offering the lowest interest rate. And manufacturers often have complex capital requirements involving their commercial real estate and specialized equipment, but also construction and renovations and working capital and business expansions, and all sometimes within the same transaction. And that makes loan structure particularly important. And for manufacturers looking to purchase, to build, to refinance, to renovate, or expand an industrial facility, three financing channels should be considered: SBA loans, USDA business loans, and conventional bank financing. And each serves a different purpose, and understanding those differences can help business owners identify a financing structure that supports both the real estate transaction and the long-term operating needs of that company. So why manufacturing facility financing is just different. And a manufacturing property isn't simply just another industrial building. And the real estate will likely include some specialized electrical capacity with heavy power or cranes and production lines or ventilation systems or loading infrastructure and wastewater systems or cold storage and clean rooms and specialized plumbing or other improvements designed specifically around the operating company. And a financing package may therefore need to cover more than just the building itself. And depending on the transaction, financing could involve an acquisition of an existing manufacturing facility, and ground up construction, and building renovations and improvements, and expansion of an existing facility, or machinery and equipment, or refinancing existing commercial debt, or business acquisition costs, or working capital associated with such a larger expansion. And the right loan program really depends on the business and the property and the project cost and the location, but also the cash flow, the ownership structure, the collateral, and the long-term business plan. So option one is SBA loans for manufacturing facilities. And for qualifying owner-occupied manufacturing businesses, SBA financing can be one of the most powerful options available. And two programs are particularly relevant: SBA 7A and SBA 504 financing. And SBA 7A loans offer considerable flexibility because of the proceeds can potentially cover multiple components of a transaction. So depending on the project and eligibility requirements, proceeds can be used towards the real estate, towards the equipment, towards the improvements, and towards the business acquisition and other eligible business expenses. And that flexibility can particularly be useful when the financing needs extend beyond simply just purchasing a building. Now imagine a manufacturer purchasing a facility that also needs production equipment and improvements before operation can actually begin. And a financing structure capable of addressing all of those components in one project may be considerably more useful than a standard conventional commercial mortgage focused only on real estate. The SBA 504 product is really designed primarily around major fixed assets, such as owner-occupied commercial real estate and long-term equipment needs. And for manufacturers making substantial investments in facilities or machinery, 504 financing deserves serious consideration. And its structure could potentially provide attractive long-term financing while also allowing the business to preserve more working capital that might be required than under a conventional commercial real estate loan. And SBA financing can be especially compelling when a manufacturer wants to own its facility rather than continue leasing. Option number two, USDA financing for manufacturing facilities. And manufacturers located in eligible rural communities may have another financing tool available, and that's USDA-backed business financing. And the word rural can cause people to dismiss the program prematurely, but that can be a mistake, and suburbs sometimes qualify. And that extends well beyond farms and agricultural businesses, but depending on the program and the property location, the project and the borrower qualifications, a lot of the manufacturing and industrial businesses are in eligible areas that are supported by USDA financing. Think Brookshire. For combining and evaluating facilities outside of certain U.S. centers, USDA options should be evaluated early in the site selection process. So, why USDA financing can matter? And manufacturing projects can be capital intensive, and a company may need to finance the land, the building, the equipment, the improvements, and the infrastructure and expansion costs. And USDA-backed financing can potentially help lenders support qualifying projects that contribute to economic activity and employment in eligible communities. And that makes USDA financing particularly relevant to manufacturers considering rural or secondary market locations where land costs, and workforce availability, and access and transportation infrastructure already create operational advantages. And that location can therefore influence more than the price of the property. It can also influence the financing of options that are available to that business. Option number 3, conventional bank and credit union loans. And traditional banks and credit unions remain an important source of manufacturing facility loans. And for established businesses with strong financial statements and sufficient liquidity and solid collateral and predictable cash flow, conventional financing may provide a relatively straightforward solution. And banks can offer financing for acquisitions and refinances and construction and equipment and other business purposes, although the loan structures and underwriting requirements may vary significantly from institution to institution. And that last point really matters. So one bank declining a manufacturing loan does not necessarily mean that the transaction is unfinanceable. And banks have different concentrations and geographic preferences and collateral requirements and loan size preferences and industry appetites and underwriting guidelines. And a manufacturing project that falls outside of one bank's credit box may fit another's extremely well. So SBA versus USDA versus bank financing. And there really isn't a universally best manufacturing facility loan. And the objective is really to match the financing structure to the business plan. And SBA financing may be particularly attractive for qualifying owner users seeking higher leverage financing involving multiple business assets or project costs. And USDA financing may deserve consideration when the manufacturing project or operation is located in an eligible market and the program meets the requirements. Whereas conventional bank financing can be highly competitive for financially strong borrowers who can meet the bank equity and collateral and debt service requirements. And the comparison should extend beyond the interest rate. And business owners should also evaluate the required equity they need to inject, but also the amortization of the loan and when the maturity is. And we have fixed or variable pricing. Do we have prepayment provisions or collateral requirements or personal guarantees? Can we finance equipment, construction, and working capital? What's the closing timeline and documentation requirements? And a slightly lower rate can become far less attractive if the loan requires substantially more equity or has a shorter amortization or doesn't finance critical portions of the project. So don't separate the real estate from the business plan. And one of the biggest mistakes in manufacturing financing is evaluating the property loan in just isolation. So suppose a company has $2 million available for an expansion. And if the lender requires nearly all of that capital as equity towards building that acquisition out, what happens when the manufacturing still needs, say, machinery or inventory or hiring or facility improvements or working capital for operating reserves? And the building might be adequately financed when the business becomes totally undercapitalized. And that's why manufacturing facility financing should begin with a complete capital stack of review. So we can determine what the business needs for the real estate and the equipment and the improvements and the reserves and future operations before deciding how much cash we can really contribute to the property. So, financing ground up manufacturing, construction loans, and new manufacturing facilities introduce another level of complexity. And a lender may need to evaluate the land acquisition, the construction budget, the plans and specs, the contractor's experience, the construction timeline, the equipment installation. What are the utility requirements? Are there any environmental considerations? What kind of equity can the borrower bring? But what's the stabilized cash flow and project completion risk? And the financing strategy should ideally be evaluated before major commitments are made to the land, to the design, and the construction contracts or the equipment purchases. An early financing analysis can really help determine whether the proposed project aligns with the realistic underwriting requirements. Financing manufacturing equipment. And manufacturing equipment can represent a substantial percentage of whatever that total project cost will be. From CNC machinery to production lines and fabrication equipment and robotics and packaging system and refrigeration and specialized electrical systems and other machinery can still require capital. And equipment should therefore be considered alongside the commercial real estate financing and not just after the building loan has already consumed the company's available liquidity. So depending on the situation, equipment may be financed in a broader transaction or through a separate equipment facility, and we can help with both. And really the appropriate structure depends on the useful life and the collateral value and the timing and the overall capital requirements for the company. Which brings me to this. The most important question isn't what's the rate. Manufacturers naturally want competitive interest rates, and I get it. But the better opening question is what financing structure can best support the business plan and reduce my capital requirements? And a loan with excellent pricing but insufficient proceeds may not solve your problem. And neither will a loan requiring so much equity that the company lacks the capital necessary to operate and to expand. So the strongest manufacturing financing structure is going to give you that Goldilocks balance of cost of capital, leverage, cash flow, liquidity, and the flexibility and execution certainty. So we compare manufacturing facility loan options before you commit. And manufacturing loans are highly dependent on the borrower and the property and the industry and the project and the lender. So instead of approaching a single institution and assuming its answer represents the entire market, business owners can benefit from comparing multiple financing strategies. That's all through me, Bill Rapp, and the CommLoan Empower program. And we help manufacturing businesses and commercial real estate investors to evaluate their financing opportunities across a broad commercial lending marketplace. So whether you're purchasing an existing facility or constructing a new manufacturing plant, or expanding your current operation, or refinancing commercial debt, or evaluating your equipment and real estate financing together, the objective should remain the same. Let's match the financing to the business plan and not the business plan to the financing. Are you ready to explore manufacturing facility financing? Well, if you are, I'm your guy. And let's talk about purchasing or building or refinancing or expanding a manufacturing facility. And we'll evaluate the financing structure early on. And we'll compare SBA, USDA, and bank and credit union, as well as other commercial financing options to help identify the best structure that supports your operations and your long-term strategy. My name is Bill Rapp. I'm a CCIM with the CommLoan Empower program. I do commercial real estate and equipment financing, and you can visit my website at billrapp.commloan.com. Thank you for your time. Take care.